Hey Iguana Nation, welcome back to Iggy's Financial Report Deep Dive. Today, we're breaking down Semcorp Industries 1H2025 results. This is a half-year report that matters for Singapore investors. Why? Because Semcorp sits at the heart of our energy story. Stable gas and power in Singapore and fast-growing renewables across Asia. If you hold it in your CPF or SRS or plan to, this is for you. Quick intro so new friends know who's talking. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We crossed 1 million reads, 58,000 likes, and I've produced over 1,000 videos with more than 600,000 watch hours as of August 2025. We focus on Singapore markets with a regional lens and macro context. Today, we'll go slide by slide through Semcorp's 1H 2025 deck. We'll decode the numbers, spotlight the risks, and give a clear buy, hold, or sell at the end. Sound good? Let's dive in. All right, slide 3, Macro Overview. The company flags 3 headwinds. 1, trade tariffs under Liberation Day have raised uncertainty. That slows customer expansion. 2, the Singapore dollar strengthened against CNH, INR, VND, and OMR. That means translation hits when Semcorp reports back in SGD. 3, China's renewables are outpacing grid growth. More curtailment, lower tariffs. For Singapore investors, this matters. FX can shave reported earnings. China curtailment can dent renewables profits. But knowing this helps us judge quality. Are these permanent or cycles we can ride out? Slide 4, 1H 2025 Group Financials. Turnover stood $942 million, down 8% year-on-year. EBITDA is $834 million, down 6%. Adjusted EBITDA, $45 million flat. Net profits $536 million, down 1%. Underlying net profit before exceptional items and DPNFX is $491 million, basically flat. EPS before EI and DPNFX is 27.6 cents. Reported EPS is 30.1 cents. ROE before adjustments is 17.8%. Reported ROE 18.6%. The board declared a 9.0 cents interim dividend payable on 26 August 2025. What stands out? Revenue fell, but profit held. That screams resilience. The 50% step up in interim DPS tells us management has confidence in cash flow. Ask yourself, how many transition utilities lift dividends in a soft price environment? Slide 5, Gas and Related Services. This is the spine of the group. Singapore spreads were weaker as USEP fell and renewed contracts had lower spreads. They also imported higher cost green power, which trimmed margin. Vietnam's Phu Mai 3 dropped out and Myingyan's inspection got extended. But here's the offset. Contribution from Sunoco Energy kicked in after Sembcorp raised its stake to 50% in June 2025. They also signed over 120 MWh of new long-term PPAs with data centers and industrial customers and secured over $650 million in new gas, power, and utilities contracts. Contracting profile remains long-dated. Think of this as your HDB lease. Stable, predictable, but with occasional renovation bills. For CPF investors, this is the defensive anchor. Slide 5, bottom left, USEP chart. USEP averaged $122 medio in 1H 2025 versus $198 medio in 1H 2024. That's a 39% drop, yet earnings stayed stable. Why? Because most capacity is under contract. This is how you want your core utility exposure structured. Lower sensitivity to spot price swings. Slide 6, renewables growth. Installed capacity at end June is 13.8 GW. Under construction is 5.1 GW. Total gross capacity, including pipeline, is 18.9 GW, with a 2028 target of 25 GWs. Renewables net profit rose 27% year-on-year, helped by stronger wind in India, first power from Mana 2 in Oman, and a 400 MWh solar project in Rajasthan. They also secured their second hybrid solar plus storage project and their first round-the-clock project in India, plus a 25-year PPA for Singapore's largest floating solar project at Kranji Reservoir. Picture this as adding more rental units with long leases and fixed rents. The more you add, the smoother your income. Slide 7, China renewables, headwinds. Curtailment rose in northwestern regions and Guangxi. Tariffs faced pressure from faster market trading and lower coal prices. Meanwhile, China's overall demand is still growing, but grid expansion lagged the pace of new renewables. This is the tough patch we expected. The key question is the portfolio shifting toward load-adjacent, better-connected sites. The company says yes on slide 8, so the strategy is to deploy capital with strict discipline, picking projects where curtailment risk is lower. For investors, watch curtailment rates and the geographic split each quarter. Slide 8, China capital deployment. The slide shows steady growth in China's gross renewables capacity, with multiple deals each year. Storage is rising too, measured in GWH. Storage helps shave curtailment and stabilize output. Think of batteries as the grab-and-go buffer that keeps power flowing at the right time to the right place. Slide 9. India, operational scale, visible pipeline. India installed capacity is 3.3 gigawatt, with another 3.3 gigawatt secured or under construction. Major projects across 2026 to 2028 include wind, solar, and hybrid with storage, backed by 25-year PPAs. A 50-megawatt round-the-clock project has been upsized to 300 megawatt. This matters. India's hybrid and storage-heavy pipeline lifts capacity factors and cuts volatility. It's like upgrading from a stall market to a supermarket. Wider offerings, steadier footfall, better margins. Slide 10. Integrated urban solutions. Land bank rose from 14,400 to 14,800 hectares by mid-2025, with a 2028 target of 18,000. Operational leasable area hit 134,000 SQM at 84% occupancy, up from 76% at FY 2024. And another 474,000 SQM is under construction. Vietnam now has 20 industrial parks. They entered Batam via a JV with Panbil Group. They completed the sale of Sembcorp and booked a 142 million net gain. What does that mean? This segment is the defensive ballast. Land, leases, and water operations that throw off cash and diversify earnings. Slide 11, Batam Data Center Angle. Batam is shaping up as a lower-cost, low-latency extension to meet Singapore DC demand. More submarine cables go live in 2025 and 2026. That boosts bandwidth and cuts latency. Semcorp's Tembesi Innovation District JV is positioned to win tenants who want near Singapore connectivity without Singapore costs. For investors, this is a smart adjacency. Power, water, land, and now digital infrastructure ecosystems. It fits the Sembcorp DNA. Slide 12. Decarbonisation solutions. The company is calibrating investments to market conditions. They're exploring renewables and green hydrogen or ammonia with BPCL in India. The Indonesia PLN EPI framework expired. They're in exclusive talks to import 1 GWh of low-carbon electricity from Sarawak and have a preferred supplier agreement with Prysmian for subsea cable design. The message: be pragmatic. Go where the economics and policy frameworks support returns. Now to the CFO section. Slide 14, Key Financials Bridge. Turnover down 8%. EBITDA down 6%. Adjusted EBITDA flat at $245 million. Share of associates and JVs rose to $211 million, helped by Sunoco and better urban business performance. DPN FX went from a $46 million gain last year to a $95 million loss this year due to INR depreciation. Exceptional items rose to $140 million, mainly from the Sembcorp sale. EPS before EI and DPN FX nudged up to 27.6 cents. ROE before adjustments is 17.8%. Translation: core operations held up. FX swung against them. Portfolio moves added value. Slide 15. Turnover by segment. Gas and related services fell to $2,093 million. From $2,338 million on lower pool prices, but higher gas sales helped. Renewables rose to $431 million from $371 million, thanks to new assets and better wind in India. Urban fell to $134 million from $209 million due to the divestment of Sembcorp. Decarbonisation solutions rose modestly. This shows the mix shift in action. Gas revenue under pressure, but renewables building. Slide 16, net profit by segment. Gas and related services. It's $330 million versus $339 million. Renewables. It's $132 million versus $104 million. Urban solutions. $74 million versus $73 million. Decarbonisation solutions. Negatives $13 million versus negatives $10 million. Corporate. Flat at negative $118 million with lower interest cost. DPN income fell to $65 million from $82 million. Net, underlying profits are stable. Renewables growth offset gas compression. Slide 17, FX impact. SGD strengthened across CNH, INR, OMR, VND, and USD. Estimated $23 million FX translation impact on 1H2025 earnings. This is not an operating weakness, just reporting currency math. But it does matter for EPS momentum. If SGD stays strong, book it into your sensitivity. Slide 18, profit geography and quality. 88% of group net profit before EI and DPN FX comes from investment-grade markets. Singapore, China, India, Indonesia, UAE, UK. Half of profits come from Singapore. This matters for CPF and SRS investors. You want quality of earnings and market-grade quality. This checks out. Slide 19, profit bridge. The walk shows small declines in gas, a nice lift in renewables, a slight increase in urban, lower DPN income, and the FX swing. Exceptional items add back the Sembcorp gain. The result lands at $536 million net profit, down 1%. If you were worried by the headline sell-off, this slide should calm you. Slide 20, CAPEX and equity investment. 1H2025 CAPEX is $412 million versus $698 million last year. Renewables took $286 million. Gas, so $114 million. Urban's $3 million. Decarb, that is $5 million. Equity investment, S25 million, driven by the Sunoco stake increase and Vietnam urban capital injections. The balance tilts to renewables. This aligns with the 25 gigawatt target. Slide 21, free cash flow. Cash from operations improved with better collections in Singapore, Bangladesh, and the UK. Investing cash inflow rose due to Sembcorp divestment and lower CAPEX year on year. Free cash flow jumped to $1.31 billion from $927 million. That's big. It supports the higher dividend and funds growth without stress. Slide 22, borrowings. Gross debt fell to $8.26 billion from $8.67 billion. Net debt dipped to $7.38 billion. And net debt to EBITDA is 4.6x annualized. EBITDA to interest is 4.3x. Adjusted EBITDA to interest 5.4x. Equity fell due to FX translation reserve declines. The key is discipline. The maturity ladder is spread, and coverage ratios are fine for a capital-heavy utility. Slide 23, debt profile and maturity. 43% of borrowings are green and sustainability linked. 81% fixed, 19% floating. Weighted average cost of debt is 5.1%, up from 4.6% at end 2024. Weighted average maturity is 4.9 years, up from 4.5 years. Rising rates have fed through, but they locked in most of the book. For investors, fixed rate bias is good insurance. Slide 24, liquidity. Cash stands at $879 million. Unutilized committed facilities are $2.59 billion. Unutilized uncommitted facilities are $5.67 billion. At trade-related lines and total unutilized facilities hit $8.26 billion. Liquidity is solid. That supports both the dividend and the growth CAPEX runway. Slide 25, outlook. Gas earnings should remain resilient despite lower spreads on renewed contracts. UK demand may dip after Sabic's cracker closure. Renewables earnings in 2H expected to be lower due to seasonality and higher China curtailment and lower tariffs versus 2024, partially offset by new projects. Urban should stay stable, though land sales could feel macro tariff effects. The group expects to maintain a sustainable dividend payout in FY 2025, aligned with policy and underlying earnings. The strategy is clear: Defend the base, grow renewables, recycle capital, and keep payout steady. Slide 26, developments to watch. Maintenance in Singapore and the UK should have limited impact. UK biomass plant Wilton 10 has a 4-week maintenance window. Vietnam renewable FIT regime revision is pending. These are small, but we track them. Substack call to action. If you want the deeper valuation workup, sensitivity tables, and a full KPI dashboard you can use each quarter, check our premium Substack post. The full model is there, including a scenario map for China curtailment, India storage penetration, and Singapore spreads. Link in the description. Iggy's overall assessment. Here's the synthesis. 1. Core earnings are resilient. 2. Renewables are scaling with better quality PPAs in India and a clear 25 gigawatt target. 3. China is a known headwind, but the company is selective in adding storage. 4. Liquidity, debt profile, and FCF are sound. 5. The interim dividend hike signals confidence. So is Semcorp a buy, hold, or sell for Singapore investors right now? My view, buy on weakness. The fair value band sits around $7.60 to say $40 based on a sum of the parts view and current earnings. A 12-month target of $8 is reasonable. I would build a 3% to 5% core position for a CPF or SRS long-term portfolio. Stagger entries between 650 and 690 to manage volatility. The key KPIs to track each quarter are renewables capacity added versus plan, India hybrid and storage share, China curtailment by province, and Singapore contract coverage. Risks to watch: prolonged China curtailment, India execution delays, interest rate surprises that lift WACC, and regulatory shifts. Upside drivers: stronger India ramp, grid relief in China, accretive recycling, and better than expected Singapore spreads. Before we close, a quick recap. Revenue fell, profits held, dividend up 50% at interim. Renewables up 27% profit. India pipeline is strong. China is a drag but managed. Debt and liquidity are healthy. Outlook is realistic, with a stable dividend stance. So if you like this format, tell me in the comments which company's results we should break down next. Smash the like button so more Singapore investors can find this. And subscribe for weekly deep dives. So, we've dissected Sembcorp Industries' 1H 2025 results, and I've given you my personal take on what it means for your investments. If you found this video helpful and want to seriously level up your investing game, please give it a like, share it with your friends, and subscribe to the Investing Iguana channel so you don't miss our next insights. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get Iggy's detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $3 a month, about the price of a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions delivered before the masses. Ready to join the inner circle and get that early edge? Just click the link in the description below to become a premium member today. For your next watch, check out our deep dive on Singapore power spreads and how they affect SP Group's ecosystem and SGX listed peers. It pairs perfectly with today's analysis.